we've had a record first half. This is the strongest first half we have had since the acquisition of Refinitiv 5 years ago. A top line growth of 8.4%. We're getting a lot of improvement out of our margin, so great operating leverage in the business. And we are also seeing real benefits in terms of a lot of the new product that we've rolled out, a lot of that being AI, where we're getting traction with thousands of users. You touched on the volatility.
Yeah.
We are seeing the benefits of volatility, particularly across our markets businesses, but also in our data businesses, where the demand for the data continues to be very strong. But in our markets businesses, whether that's foreign exchange trading, fixed income trading, the various derivatives asset classes in the clearinghouse, and of course equities, we saw a very strong first half really across the board. And we'll see what the volatility looks like in the second half, but we have a lot of confidence in the performance for the full year in the second half. And as you mentioned, we have upped our both revenue and margin guidance, full year guidance for the rest of the year.
Now, the last time we spoke to you earlier this year, we talked a little bit about buybacks, and I'm wondering, you have a new buyback announced this morning, £1.35 billion. I'm just wondering, was there much pressure from shareholders, thinking about management as well, to up the amount of that buyback? How much influence did they have?
No, this is just the completion of the $3 billion buyback that we announced earlier in the year. So we've done a good amount of that in the first half, and then what we have announced today is just the completion of that amount. So I think there is a reflection in that of the very strong cash flow that we're generating. And at the same time, we have plenty of capital to continue to invest, whether that's organically, whether that is through bolt-on M&A that we're always evaluating. So the buyback is sort of a steady as we go here.
One of the main issues for the UK in the past decade is this shrinking stock market. It's both from kind of cheap valuations and therefore stock companies being bought up, also a lack of IPOs. Do you think that the UK will have a globally significant stock market in a few years' time? Absolutely.
So first notion that M&A on the market is a bad thing, I think is frankly completely wrong. A healthy market has M&A. And I think we've seen very healthy M&A activity in this market, and a good corporate regime and good disclosure and great companies. I think where there has been a challenge, not just in London, but around the world, is in a reduction of new companies coming to the markets. Now, we actually have a great pipeline for London here, and reported pretty much day after day or week after week in terms of new companies that are planning to come to London. They're not going to come in August, but we expect to see more in the back half of this year, as well as going into 2027. And I think that's the key aspect in terms of getting that kind of replenishment of public companies on the markets. Now, we've also seen the development over the last 10, 15 years of very robust private markets. And in many ways, because of the availability of capital in the private markets, that has reduced some of the need, if you will, for companies to go public. We also have great offerings to address the private markets as well, and we're getting real traction with our private securities market, where just this past month, we have seen offerings from Wave and Moneybox and others that are really taking advantage of this innovative new platform, our private securities market. So absolutely healthy markets going forward, whether they be private or public.
I'll come back to the private markets in a moment, but just on the IPO pipeline, there have been quite a few deferrals of listings, the likes of Waterstones, for example. I mean, is that down to market volatility? Are you worried about when you see those numbers of deferrals?
I'm not worried about the volatility in the markets. The volatility in the markets is what it is. And in many ways, the volatility is healthy for other parts of our business. When I look at the London markets, yes, of course, sometimes volatility will have an impact on companies' decisions as to when they want to access the markets. Companies often don't want to access the markets if there's great uncertainty. That can be political. It can be about interest rates. It can be about concerns about war. But companies need capital. Companies want that capital to grow. And I think we are getting into an environment here where, in many ways, the volatility is the new norm. And companies recognize they have to sail through that and access the market so that they can raise the capital that they want and need to grow.
There is a concern, though, around the UK in the sense that, low valuations, yes, it might kind of propel M&A, but it also does mean de-equitisation and a lack of competitiveness. And part of that is in terms of the relative disadvantage that some see because of the 0.5% stamp duty on share purchases in the UK. Have you had any conversations with Andy Burnham or his team, the new Prime Minister here in the UK, to try to convince him, this has been a long-running saga, try to convince this iteration of government to actually remove that tax, to try to do what the government seems to want to do, which is to encourage investment in stocks?
So I think there are a few different aspects to this discussion, and we've been involved in pushing on a number of them over the last several years. I think the notion of the stamp tax on the equity markets is one that comes up time and time again. Of course, we'd love to see that go away. I think it is the wrong incentive structure in terms of having robust trading in listing in this environment. I think there are other levers as well, and one of the big ones is pension capital, where the UK, of course, has huge pools of pension capital and, frankly, underinvests in its own market. And I think there's an opportunity, not through mandation, but there's an opportunity through incentive structures, including the very large tax benefits that go to the pension funds, of creating, I'll call it a default minimum amount of allocation of capital to the UK, which could have a big difference, a big impact.
There was work with Rachel Reeves and others, doing that. Have you had contact with John Healey or Andy Burnham on those points to press those issues that, as you say, are long running? This government's talking about, quick changes. Are they going to do something? So
I'm not going to comment on any specific discussions, but I think there are signs of receptivity in terms of some of the reforms that we've been talking about with respect to pension capital. So we'll see how that plays out.
Are you more optimistic about changes now than you were with the last government?
I would say a little bit, yes.
Just coming back to the private markets question, given that we're coming up to a year anniversary of the Pisces framework, what looks like success for you in that market? You've talked about the activity you've already had. What benchmarks are you setting?
So early days still, but I would say already a really good start. And I'd like to see a healthy, ongoing flow of companies accessing that market on a regular basis, so that we have a very healthy public market ecosystem and a very healthy private market ecosystem. And it's doing well thus far, and I look forward to seeing that continue.
Okay, just lastly, sort of circling back to what you also said earlier, on the relationship with Elliott Management now, do investors see that as positive?
Do investors see
the relationship with between LSEG and Elliott Management as positive?
Can't really speculate on what our other investors see about that. I would say our own interaction with them has been really constructive. And we have ongoing dialogue with lots of our shareholders. Now, our shareholders do have different views on things. Some of our shareholders have more of a short-term perspective. Some of our shareholders have more of a long-term perspective. And they don't always agree with each other. But we listen to all of them, and I would say have had constructive engagement with that one in particular.